Welcome to the third part of Chapter 3. In this section, we will learn about current assets and current liabilities and how they make the balance sheet more informative. We will also learn how to calculate and evaluate the profit margin ratio and the current ratio. A classified balance sheet organizes assets and liabilities into important subgroups that provide more information to decision makers. That would be you business people in the class. A classified balance sheet then is one of the most popular formats used by business. On the asset side of the balance sheet, we group assets as current or non-current. A current asset is one that is expected to be converted into cash in 1 year or within the company's normal operating cycle, whichever is longer. I always think about current meaning 1 year or less. On the liabilities and the equity side of the balance sheet, we divide liabilities between current and non-current. And a current liability is one we expect to pay out of the company's current assets within a year. Current assets normally include cash, short-term investments, accounts receivable, short-term notes receivable, merchandise inventory, office supplies, and prepaid expenses. There's a list of these in your book. Short-term investments are expected to be sold within 1 year of the normal operating cycle, whichever is longer. Merchandise inventory contains inventory items that we expect to sell to customers in the normal course of business. That would be like, I don't know, towels at Walmart or shoes at Target or cologne at Macy's is merchandise inventory. For a service business like a law practice, though, we would not expect to find a merchandise inventory account because they don't buy and sell inventory, they just sell services. A second major balance sheet classification then is non-current or long-term investments, meaning those types of investments we mean to hold for more than a year. Common types of long-term investments include notes receivable and investments in stocks and bonds and land held for future operations because it is currently not in use. Now, companies often purchase the stock of another company in order to control or own the other company, and this would be a long-term investment. The third major classification on the asset side of the balance sheet includes plant and intangible assets. This section includes the productive assets of the company, along with any land-containing structures such as building. And remember, we will show the contra asset account called accumulated depreciation here, or disclose it in the notes to the financial statements when reporting under GAAP. Productive assets include those we are using in the operation of the business, such as machinery, equipment, furniture and fixtures, and buildings. Productive assets are normally depreciated over their useful life, as you've seen. And as you've seen, the cost of any asset less its accumulated depreciation is called book value. And again, we don't ever depreciate land. The final category of assets then on the classified balance sheet includes intangible assets. And intangibles include long-term resources that you can't touch. They lack physical form. They include accounts like patents, copyrights, trademarks, and goodwill. In general, it's very difficult to properly value intangible assets. We will cover both of these types of accounts, plant assets and intangible assets, in Chapter 8. So in summary, we have current assets and non-current assets that are divided into long-term investments, plant assets, and intangible assets. Current liabilities, moving over the right side of the balance sheet, current liabilities are obligations due to be paid or settled within 1 year. Again, think 1 year or less with the word current. They are usually paid off by paying out of current assets such as cash. Now, current liabilities often include accounts payable, notes payable, wages payable, taxes payable, interest payable, and unearned revenues. Also, any portion of a long-term liability due to be paid within 1 year is a current liability. Okay. Current liabilities are reported generally in the order of those to be paid off first. Long-term liabilities include long-term notes payable, mortgages payable, and bonds payable. We'll be covering the accounting for liabilities in Chapter 9 and 10. Let's take a look here at how fast-forwards accounts would appear on a classified balance sheet. A classified balance sheet separates the assets into current and long-term, or in this case, the only long-term asset is a plant asset category. It also separates the liabilities into current and long-term liabilities. Fast Forward only had current liabilities. When data is presented in a classified format such as this, it makes calculation of key ratios easier. Profit margin, then our first ratio, is an important measure in business. It's very common. It tells us about the relationship between sales and profits or net income. We calculate the profit margin ratio by dividing net income for the period by sales revenue. And a high profit margin is an indicator of future growth. Now you can see the profit margin here at Limited Brands for the year 2009 through 2013. Remember that for numbers to become useful, we must have other numbers to compare them to. In this case, it's always a good idea to compare either year to year or compare the company's profit margin to that of other companies in the same industry. During 2013, Limited Brands generated a profit margin of 7.2% versus the industry average profit margin of 1.7%. So they were doing pretty well at that point. Please recompute that 7.2% on your own. The current ratio is commonly used to indicate whether a company can pay its debts in the near future. It's one of several ways to measure a company's liquidity. The current ratio is used by suppliers then when deciding whether to let a company buy on credit. And it also affects decisions by creditors when lending money to a company, including such things as the interest rate, the due date, and collateral requirements. Finally, the current ratio can also affect a manager's decisions about using cash to pay debts when they come due. The current ratio then is calculated by dividing current assets by current liabilities. Let's take a very quick, easy example. Suppose we have a company that has $200,000 in current assets and $100,000 in current liabilities. 200 divided by 100,000 gives us a current ratio of 2 to 1. A 2 to 1 current ratio means that for each dollar of current liabilities coming due in the next year, we expect to have $2 of current assets out of which we can pay the liabilities. Limited Brands' current ratio averaged 1.9 for its fiscal years 2008 through 2013. If the ratio were less than 1, current liabilities would exceed current assets, and the company's ability to pay short-term obligations would be questionable. Limited Brands' liquidity, as evidenced by its current ratio, declined in 2011, 2012, and 2013, dropping to 1.4 in 2013. However, the trend roughly matches the overall industry decline. Well, good job then. You are through the basics of bookkeeping with Chapter 3, and now starting in Chapter 4, we move on to the real accounting. So at this point, please refer back to your checklist for success to see what to do next. The process of preparing adjusting entries and closing a company's books is difficult. If adjusting entries or closing entries seem unclear to you, you may need to review the material one more time. course, you will get to reinforce what we've discussed when doing your homework. And you might also try the practice assignments and interactive presentations provided in Connect. Um, they provide good practice to reinforce what you have learned. Have a great week and see you online next time.